In today's episode, we have a very special guest. We have Oliver Studd, founder and CEO of Valhalla Network DAO, working alongside famous economist Richard Werner to establish and own a global network of community banks to combat the ever-encroaching centralization of global banks. I'm your host, Jaime, along with Internet Joey, and together we are New Fronts Radio. Quick disclaimer, everything we say or do is for entertainment purposes only. We are not financial advisors. So with that out of the way, how are you doing, Oliver? Thanks so much for coming on the podcast.
Hey guys, thanks for having me. Pleasure to be here. Can't wait to kick-start this. If I make any grunting noises throughout, it's because I've injured my back this week. So if I shift my weight, my back tends to send a pain up my body. So
no worries, man. So I'm going to go ahead and start us off on how we actually found you. So a few weeks ago, I found Richard Werner he was on a podcast. I believe it was Patrick Bet-David's podcast. And he blew my mind when he talked about how money creation actually works. I always assumed it was just central banks or governments created money, and that's just the way the world works. And he completely destroyed all those ideas that I had, along with a lot of other economic ideas. I mean, he coined the term quantitative easing. It was very relevant to me that I didn't even know what that meant when he talked about it. And then I kind of just became obsessed with some of his other content. I saw his documentary, Princess of the Yen, another really great informative documentary. It really breaks some of the ideas that people have on economics, on quantitative easing, and on inflation. The idea of inflation is a lot different than what the public perceives. And then following that trail, I also found you. I saw he's working along with Valhalla DAO to create some pretty interesting things. So I wanted to ask you, what kind of got you involved in creating Valhalla Network and got you working with Richard Werner?
Yeah, so we'll start with the second question as it's chronological order. It makes more sense to me. So Richard and I go back to university for my master's degree. So Richard was a program leader at Southampton University, and he was the program lead for it. He was my supervisor for my dissertation as well. Let me just turn out Do Not Disturb. He was my supervisor as well, and my dissertation was on credit creation in Ireland and how the nominal GDP of Ireland changed with credit growth and stuff like that, how it was impacted by credit creation. And I can't remember the time period now. It's a few years ago. So I met Richard at university. I was the only British person in the class, actually. Studying the course that year, and I asked Richard lots of questions, read his books, watched the documentary, was quite engaged with learning about it, and stayed in touch with Richard after I left the university and worked for HSBC for a couple of years. But while I was at HSBC, it wasn't what I wanted to do. It wasn't what I was passionate about. I knew the big banks were hurting economies more than they're really helping them. And that they don't help small businesses despite the amount of marketing and advertising they might do, saying we've got 400 million, 300 million in this fund for small businesses. Well, for a big bank, 300 million is a very little amount. And how much of that is really going to go to the small businesses that need it? And is it going to be correctly given out to them for the right reasons and stuff like that? So HSBC wasn't for me, despite it being a good company for an employee to work at, and I learned a lot while I was there. My manager there was fantastic, and I certainly have no grievances working with them. It just I knew that for me it wasn't the job I wanted to do forever. I didn't want to be one of 230,000 employees, so I resigned from HSBC. I started working as director at Local First with Richard, so I joined Richard's community interest company, Local First, and Local First's mission is to promote community banking and to educate and explain to people why local community banks, small banks that create credit and lend for small businesses is so important for the economy. Mostly working with councils, so mostly discussing it with councils and getting them involved and working with them to set up a bank in their county. as a county community bank. So I worked with Richard for a few years, a couple of years at Local First, working on Hampshire Community Bank, which was already in progress. I joined when it was already in progress, worked with the bankers, and I joined as Hampshire Community Bank as a consultant from Local First. Well, I was working for Local First. They engaged me to them. I then joined as consultant to help them with their bank application process. So working on the bank license application documents, which, as you can imagine, it being the most regulated industry there is, there's hundreds and hundreds of pages of documents. So plenty to do. So I learned a lot through that process as well, worked with some fantastic people. And in doing this, I also noticed inefficiencies. And I noticed that they were trying to do this on a large scale would be pretty much impossible like this, because every single community bank, you have to engage with the council, you have to convince the council, you have to do a new pitch for every single one. You then have to do a study in the background to show that it's feasible. You then have to speak to their finance department and then another department and another department, and you have to keep justifying it to everyone. And then even after a very long time,
how long does it take for a bank that's starting out?
Oh, well, so this is just actually to get the council involved, to get them to put the money in.
Oh, wow.
And that can take a year and a half, 2 years maybe, to convince the council that, look, this is a great idea and it's a good use of the public funds to invest in a bank. Then to start at the bank, so like Valhalla Network community banks, it will take us about a year to a year and a half. Sorry, a year and a half to about 2 years actually, from the date that the idea is decided on and the money is going to be injected to the date the license will be received. Once we've done it a few times and we've done it in the jurisdiction already, it will be a lot quicker because we will have already known the regulators, and a lot of it will just be simple sort of copy and paste with then different details. So that will be a lot quicker then. But to start out, it will take about a year and a half to 2 years. Hampshire Community Bank, it had councillors involved. So, you know, it's a long process of speaking with councils, getting their support and backing. And I noticed that although it was important, and it's still a great idea and a great model to get the councils involved and get them to support the bank, and there's nothing wrong with that, that's brilliant. But on a large scale, it's just too cumbersome for like one company to do. So I took it as a headache. I then thought to myself, and I was speaking to a friend of mine at the time who introduced me to DAOs actually. He explained to me what a DAO is in simple terms. And I thought, this is a great idea. Why don't we do our community banking mission through a DAO so that the public is still effectively owning the banks, or they have governance over the banking system through the DAO. However, it isn't cumbersome, it isn't inefficient. You don't have to keep pitching the idea to new people, new council members, if you like, every single time to get the money injected. Instead, you propose the idea, you write a business plan, i.e. a white paper, if you like. You convince people, this is a great idea, this is what we're going to do, this is how it helps local economies, and these are the returns that the DAO will be making in long term. And then once you've done that, the governance token holders will then be voting on and deciding where we set up the banks and how many of them and when we're going to do it. So then we don't have to keep convincing new people. It's the governance token holders just voting on it and approving it and doing it. So it was about 2021. So it was last year, about a year and a couple of months ago, when I was talking to my friend. That's when the idea sort of originated. I then spoke to Richard about it, who was 100% supportive. He quickly understood what I meant about doing it on a larger scale across the whole world, so not just the UK, and trusted me. Yeah, okay, I'll give you some free reins to discuss this and look into it in more detail and crack on. I then advertised, if you like, in Richard's official Telegram channel, that this is something we're working on. We are looking for an architect or someone to get involved on the tech side of Web3 to help us come up with this decentralized model so that the banking system can be owned or governed by everyone. And we had some interest come through. Funnily enough, the gentleman, Ben, my good friend who I'm working with, he messaged me and I actually ignored him for a month just because I simply forgot to get back to him. So I remembered and got back to him. Luckily, he's patient, and we got a call booked in. He introduced me to his friend Rome, who was a CTO on another project as well, and he loved the idea, can see the benefit of it. We met in Lisbon for ETH Lisbon, and then the team grew. We brought in some more tech people, and Theo on the governance side, who is probably one of the most educated in DAOs. He's been in the space since really DAOs originated. And then it sort of grew from there, and the white paper was released in December, January. So I hope it's a long answer to the question, but I hope it got there.
Yeah, so it's almost like you guys are raising capital to create decentralized community banks. Is that an accurate description?
Yes, we're raising capital to, and it's just important to be clear on this for when we're public. We're raising capital to establish a DAO, to establish a foundation.
Gotcha.
Whose mission is to then establish a global network of banks. And the global network of banks is underneath the DAO, so it's governed in a decentralized way by the people. And the community banks operate for the people by lending to small businesses, which is the real economy, which I'll get into in a moment as well about the real economy.
Gotcha.
But because it's lending to these small businesses, it's acting in a way that supports local economies and the people, and it's decentralized and it's governed by the people. So that's what we're raising money for.
Gotcha. And who's doing the acquisitions of the actual banks? Are you guys just finding banks that are, they're about to do a merger, they're doing weak, and you guys kind of come and rescue them, or how would that work?
No. So primarily the DAO's, the foundation's business model is that every single new bank the DAO will start up and invest in will be from the start, i.e. it will be originated, there'll be a bank license application process, and every single bank will have its own bank license, which has inherent value to it. So it's actually a really good idea for every single bank that we set up to have its own banking license, because not only does it make it a standalone bank from the other banks, which is really important, although there is a way you could have it where each bank is kind of standalone but has one banking license. It's a good idea to have multiple banking licenses because then you increase the value, because effectively a banking license gives the bankers the ability to create money out of thin air. Imagine if I gave you a wand and you're a wizard and I taught you and I gave you a wand and the wand gave you the power to create money, to create free money or create money out of thin air. You would want that wand, and Joey would want to buy that wand off you. And I think Joey would spend a lot of money to buy that wand off you. So therefore that wand has a lot of value to it. And that wand is effectively a banking license. So therefore it's a good idea to have lots of these banking licenses, because then we can sell lots of these wands if we wanted to. In the end, let's say the governance token holders said, let's set up other banks elsewhere, or one of the banks was going down and something was wrong. It's always a good idea to have lots of these licenses so you have more value. But that would be, the chance of that happening so low anyway. But because there's always ways to recover and ways to help the situation. But yeah, they have their value. Whereas if you had it over one banking license, you'd run the risk that whoever was in charge of the actual organization itself, there has to be someone in charge of the organization for the bank, could make a decision to shut down a branch, or it would have effectively one balance sheet, and it would be a pain. And also you would have to have different banking licenses for different jurisdictions anyway, or passport. But yeah.
Gotcha. Okay. And I know you guys said you guys kind of want to adopt like kind of the German model where small banks only invest in their local area. How is that distinguished, or how is that determined? How broad that area is, or how do you determine how far, like the turf between banks, one bank and another, of how far they can lend or what companies they can lend to?
Yeah, it's a good question. So yes, our model is based on So it's a tried and tested model. And that's what's so great about Valhalla Network. Well, there's many things great about it. One being that over 80% of the total capital we're raising in the private round. So we're raising 22 million at private. Over 80% of that isn't even being touched. It's not even being, it's not being spent. It's not being burnt. There's always risk to investors. Let's be honest, there's risk of fraud and everything like that involved. So therefore, I can't say there's no risk to investors. But we're controlling the risk. We're controlling the downside by saying that over 80% of the money we're raising isn't being spent. And it's only the risk increases when we get a banking license. But at that point, the regulators have done so much more due diligence than any investor can do. Which means if everything went wrong and for some reason we couldn't get banking licenses and we couldn't try multiple things and the governance token holders, the investors said, look, we want our money back. Over 80% of the money is sitting there and they can have that back. So that's one of the great things. But the second great thing is that it's a tried and tested model. So the Sparkassen is 1,500 community banks in Germany, small banks that are owned either by local authority or the people, or you've got two different types, which are effectively community banks. Anyway, you've got 1,500 of them, all in a network helping each other out, which will be a little bit like Valhalla Network. They only lend to small businesses in the area, and that's decided. Well, it's difficult. I don't know what they're called in Germany, like the districts. In the UK, you've got counties breaking up, so it's very clear where one county starts and where another. Where it ends and where another one starts. I'm not sure what it's like in other countries, but there's always some sort of jurisdiction between different provinces or whatever.
In the States, it's very similar. We have districts, or not district, counties. We call them counties also. It's, each state has, hundreds of counties, divided them up.
Yeah. So there's always some sort of barrier, and line that says this is your turf and this is your turf. However, saying that, that's great to focus the banker's attention, but that doesn't mean that you can't have two community banks in one. And the reason I say this is because competition is so brilliant in banking. You need competition there. It's bad to just say, oh, we're just having one and that's it. No, you want competition. Saying that, you don't want to focus on just putting in competition, because if a community bank's already there, it's not urgently needed for another one to come in. So it's better to start one up elsewhere. But the reason this is so great to focus a banker's attention on the local area is, again, you're a wizard and you have your wand. And I say to you, you can create money for businesses. And to do that, you have to fill out this document. You have to present it to Joey, who's your credit officer, and he's going to look at it and decide whether or not you can wave your magic wand and create that money. So you have to first get approval before you can do it. And I give you some businesses here in your local area, and there's a few which are great, and there's a few which are a little bit like, it would be great to support them, and definitely they need it, but it would be difficult to fill out the form, and Joey might not like it, and there might be some backlash, and I really just want to use my wand. I want to create that money. But there's some businesses over in that area which are very easy. I could easily fill out the form on them. They've got loads of security, and there's Joey's not even going to have any issue at all with them. He's not going to ask any questions, and it makes my life easy. I can clock off. I can go home for the weekend and see my family. You're going to do what everyone does, pretty much, and say, okay, I'll pick the best businesses here, and I'll pick the best businesses in that area, and that's my job done. I've helped all those businesses out, and Joey's happy, and I've created all this money, and I've helped those businesses. The problem is, you've got businesses in your local area that you haven't now helped. So by focusing the banker's attention, saying, no, you can't go and pick the businesses over there because that's another district. Another bank will handle those businesses. You've only got the businesses in your area and you need to be able to serve them. So then you've got to come up with a way of how best for the bank and best for the customer to support them. So you first, you get them to a room, you speak to them, you really go through what they're trying to do. You question them on it, you give them support, and you sort of use that relationship not just to give them a loan, but also to help them in sort of viewing it and actually executing it, and being a real sort of partner for them, a real financial partner, and not just not just the bank that gives me money. And it also means that not only are more businesses in the area are helped, and you've got more employment and everything in the area, but you've got a real good relationship, a real good community relationship between the bank, the businesses, the people, and also through schools. And that's another thing I'll discuss in a moment. But that community feel, that community vibe is so important, because not only does it make everyone happier, but also it actually means the risk of default is going to decrease even more. Because if you're a small business owner, and if Sparkcars have it brilliantly because they've got many generations. So the bankers banked their father, and now the son runs the business, or the daughter runs the business, and they know the bankers, and the bankers know them because they saw them when they were children. So now they've got that, they've already got that relationship. So it's even better than it originally was. And then another generation through, and the bank has been their bank for 50 years, 60 years. So they've got it really strong. But again, you're a small business owner now, let's say, and you're in the local area. I'm the wizard. I've used my wand and I've created that money through the banking license. You've got the money. I've really helped you out. Do you know that I've put my neck on the line for this? I've had to work. I've had to speak to you. I've had to come up with a solution that works for everyone. I've even offered you a flexible repayment schedule so that it works around your seasonality. Let's say you make much more money in the winter than you do in the summer. So I've given you a flexible repayment schedule where you can pay it off more in the winter months when you're making more money. So I've done loads of things to help you. I'm not a big bank. You know I'm not a big bank. You know that I'm a small bank, and to help all these small businesses in the area that you want to see helped as well, because it helps everyone. It helps you. It helps more tax coming in as well. It helps employment. So you want these small businesses to exist as well. You're not going to want to default on that loan. You're going to try your best, and you're going to work with me to make sure that you can repay the loan, because you know it's important to us that you repay that loan. Because if you don't, and we get loads of bad debt, we're in trouble. So therefore, you've got more of a moral obligation as well to repay the loan, not just a legal obligation. You can't just throw in the towel and say, oh, I'm going to bankrupt, or I'm going to move my funds to another company, or I'm going to try and do something shady, or I'm not even going to do something shady, I'm just going to dispute it, or I'm just going to take them through the courts just because I know that they are going to want to settle with me, because it's more cost and more pain to go through the court. So therefore, they're likely to settle with me for half a loan. All these sort of shady things that businesses might try to do, you are more likely to do if it's a big bank, because the big banks, they're huge. My money, I'm a very small customer to them. I'm such a drop in an ocean that they're not going to even mind it. They're not going to bother. Whereas a small bank, that it's going to have a huge impact on me, or at least a bigger impact. So you're much less likely to do it.
Yeah.
So that moral obligation as well is so huge.
I was going to say, it sounds like you're kind of fixing these problems, and with bringing back the relationship of small business to small bank. And, this is, you can fix a lot of these problems that we're currently facing by building that relationship. And I think it's a great idea. And like you said, bringing that moral kind of ethic to business.
That totally makes sense, because if I put myself in the position of a small business owner or a firm, and I'm working with my small bank, well, I'm going to think twice before defaulting on that loan. Because now, if I default, not only am I hurting myself and the bank, but I'm hurting my local community, and I'm hurting other local businesses that are invested in that bank. Whereas if I'm defaulting on a loan on a big bank, well, I have that disconnect with that big bank. I have that disconnect. Yeah. I don't really care. Okay, well, I'll default, I'll declare bankruptcy, and I'll move somewhere else. Whereas, I have, like you said, I have more of a moral obligation with the local community, not just the local bank, but the local community as a whole.
You're right. And also another thing to keep in mind is the big bank, especially for small businesses. For big businesses, is not such the case, but for small businesses, you call through to a helpline effectively. And I know this because I saw it while I was at HSBC. Small businesses call a number, and you're not always speaking to the same person every time. You're not treated, you've not got that dedicated relationship with the bank. So you don't even have that initial contact where you feel like they're on your side and you know them all by first name basis that you need to speak to. They also might not live near you with a big bank, so therefore you're not seeing them. Whereas a community bank, you've got that dedicated relationship manager who sees you in person and has come around to your business. Big banks, by the way, for small businesses, they don't visit every single small business. They can't. So it's much harder for them. A lot of it's over the phone and application process, but a community bank can go and visit the businesses in the community and work with them. So you're seeing that relationship manager in person. They might live near you. So then you're going to be seeing them in the store and stuff like that. So if you try and do anything shady, and I'm not just saying the business is going down and you haven't worked with the bank, because that's really important when you're struggling to then work with the bank, because the bank can normally always do something to help you. It's not, at least they shouldn't be. Again, I'm not saying the big banks do this, but they have been in trouble in the past for it. Like RBS in the UK got into a lot of trouble for this, and it was proven that their investment banking division were actually really bad and at times were not acting in the best interest of customers, and were looking more at the default situation and the collateral they could get and then selling the collateral. So they have been known for this, and that unfortunately tarnishes the reputation of bankers. But community banks, again, they're for the community. So they're not trying to do that. They're trying to work with you and make sure the business survives and they get back their money. So they want these two things to happen. Because if a business doesn't survive, although yes, there's collateral and security, and yes, it's still likely the bank will get back their money, it's a lot more hassle, and it doesn't help anyone really. So they'd rather the business survive. So maybe, okay, we'll delay a few payments so you've got more money there. Let's discuss your working capital situation. What are you doing to address this? Okay, what are your financial forecasts? Are they justifiable? Can you justify these forecasts? And really sort of running them through and discussing it with them more. And then, okay, we understand your business plan. We understand what you're planning on doing on the short term. So therefore, we can give you a bridging loan to help you out. So we can actually give you more money, or maybe something like that. So the community bank can normally help small business. And then when they see them in the store and stuff, so unless the business has gone down completely the legitimate way and there's no funny business, it's going to be an awkward situation, because you've seen that banker most days now and he knows that you're scummy and that you try to rip the bank off and you are hurting everyone in the local area. And although data is private and everything like that, it's still very difficult, and there's a set amount of time, and especially if it goes through the courts and things are public information, some people might find out. If it's public information, it's going through the courts, the local community might find out about that. And that doesn't help the person either. And so there's much more of a moral obligation there.
I was muted. All right. So I wanted to make a quick pivot and talk a little bit more about central banks. We know that a lot of small banks have disappeared over the last 20, 30 years, whether that be in Europe, in the US, and other parts of the world. Why is it important for small banks to resist? I mean, most of these banks have disappeared through mergers. They merge with larger banks who are just outcompeting them in their local area. Why do you think it's important for these local banks to resist getting a merger or disappearing? And why should the average person care? Because most people don't even know what's going on. And we can touch on this later, why most people don't even know this mechanism works or how money creation works. But why is it important for people to know, and why is it important for small banks to really resist that centralization of banks?
Yeah, great question. So you've hit the nail on the head when it comes to the reason why. Many people, justifiably but incorrectly, believe that small banks are struggling and they are they're just having to get together and work together to survive, or they're just shutting their doors because they can't survive any longer. It's not that. It's actually the small banks are doing fine. The big banks look at these small banks and think, okay, that's an attractive bank there that we can buy. And we'll buy that. It's a bit daft because the small banks are normally having a completely different customer set, and the big banks don't want small businesses anyway. Big banks have their role. They have their role in the economy and in society. Their role is big businesses. That's fine. And that's fine, but it does mean we need small banks. So them acquiring the small banks doesn't help anyone. So you need a structure in place which prevents any selling or any takeover. And that can be either through a charity foundation that owns 50% of the shares, which is how we've done it through Local First and Hampshire Community Bank. So therefore, no matter what the council decides to do, the bank can never be bought out and then the business plan, everything changed, because 50% is always owned by a charity foundation that has rules. In our case, it's even better than that, because it's a DAO that it's a foundation that owns the banking system, and then it's governance token holders that then vote on what the foundation does. So you've even got more of a decentralized governance framework. So it's really difficult to take that over, really difficult. And not only is it difficult to buy out all these token holders and everything, but every single vote, every single token that you purchase, the vote you're purchasing is less each time, if that makes sense. So it's effectively becomes more expensive to buy your voting power as you accumulate tokens, which means that if you own 50% of a supply, you might, and I don't know the exact maths, or I don't think it's been worked out yet exactly how we're going to do it, but you might only own 20% of the voting power. Or if you have 80% of the supply, you might only have 40% of the voting power. And it might be really, really expensive to get over 50% of the voting power until that very last token that you purchase, and then you've got 100% of the voting power. But that's very difficult to get to, because someone out there is always going to say, no, I'm not selling my token. For example, I might just say, I'm not selling my token. As long as I've got a supply amount, I know that the DAO will never be taken over by one party at least. So it's really difficult to do, really difficult to take over. And the central bank, centralizing of power. So like the Soviet banking system, where there was just one central bank and effectively one bank, was a very bad system that led to many bankruptcies, mass unemployment, suicide rate went up and everything like that. But small businesses weren't able to survive. And they're the backbone to any economy. They're the lifeblood to the economy. So the more you centralize everything, the more big banks there are, and then the fewer and fewer of banks, the more of those you have, and the more centralizing that happens, the less chance a small business is going to succeed at getting a loan. So when we did a survey last year of over 100 small businesses, we found that over 2/3 won't even approach their bank to ask for a loan, because the hassle of applying and the fear of being rejected. Well, not really fear, but they just know that they're not going to get it through because the bank's so difficult. 2/3. Over 95% of respondents said that if a community bank was set up in their area, and the phrase was seriously consider switching. 95%. And 95% also supported a new community bank to be set up in their area. So that really shows you that these small businesses aren't getting the funding that they need. And there's loads of other metrics and questions we asked, but they're not getting the funding they need. They're not being treated as well as other customers of the banks. And they need a bank dedicated for them. So the more centralizing of power you get, the less loans are going out to small businesses. They're the lifeblood of the economy. In the UK, I think it's over 2/3 of total employment is through small businesses. It might be even more than that, but they make up the majority of employment, which means that if you shut them off to credit supply, these small businesses can't survive. They can't grow, meaning employment goes down as people are being fired and laid off. Inequality goes up. You've then got those few big businesses surviving with the big owners and the shareholders making loads of money. So that's why you get inequality going up. Communities are struggling, because if you've not got thriving small businesses in your community, the community itself is not going to thrive. You've got less tax being paid. So less public spending as well can happen. So it's a magnitude of negative things happen when you've got fewer and fewer banks. And Professor Richard Werner, he did a study, I think it was last year, it might be the year before, where he looked at the US actually. He looked at America, and it was called something like propensity of banks, or banks' propensity to lend to businesses as bank size grows, as banks grow, something like that. Just Googling that will find the study. And what he found was that there is a strong relationship between bank size and small business loans. So as banks grow, their propensity decreases. Their propensity to lend to small businesses decreases. They're less likely to lend to small businesses. Whereas if a bank stays small, they're more likely to lend to small businesses.
Why do you think
so
that
the
is?
next question is why?
Yeah.
Why exactly? Why is this? If you're a big bank and you've got lots of money and lots of equity and lots of set one sitting there, so you've got all those regulatory buffers covered, and you've got Joey, who is a huge private equity company, and he wants to borrow 200 million off you. And he's told you, look, we're a big private equity company. We've got a reputation. We know what we're doing. We're going to use this 200 million to buy out this big business and acquire this big business that makes plane parts, something like that. And you're looking at that. That's 200 million. Okay, Joey's trusted private equity company. Sounds like a good business that they're looking at, but they've done this lots of times. They've got a track record, big people involved, lots of money involved. We're just one of a syndicate, let's say. So there's another bank, another three banks, let's say you're putting 100 million in, and there's two of you, or something like that. Obviously, syndicate's normally more, but ignore that. Or you've got me coming up to you, and you've got 199 other people like me coming up to you saying, I'm a small business owner. $1 million's still a lot of money for a small business owner, but let's go with it. I'm a small business owner and I want to borrow $1 million off you, $1 million off you. And you're saying, okay, well, Joey wants to borrow 200 million. And if I lend to Joey, I only need to fill out that annoying credit form once and go through the credit process once and get it all approved once. And I only need to do the checks once, and I need to know that guy once and write about it once. And then I can use my wand. Then I get that access to wave my magic wand. Or I can fill out this form 200 times, each time having to speak to new people and get to know them and their business and do all the background checks and everything like that, and make sure the collateral is correct and everything like that. It's a lot easier for me to lend to Joey. It's obvious that you're going to choose Joey. And you're going to lend that private equity company 200 million. Well, what effect does that have? The small businesses, me and the 199 others who came to you, aren't getting that money, which is why as banks grow, their propensity to lend to small businesses decreases, because it's more likely that they're going to choose big businesses. Like I said, that's not a problem. That's fine. That big banks have their role in society. But if that's the case, you need small banks to fill that void. And that's what's great about Valhalla Network as well. The Valhalla Network community banks we want to set up aren't competing with the big banks. They're not. They're filling the void that already exists. Small businesses need small banks. So we're filling that void saying, look, this is actually great for big banks because they no longer have to worry about, their marketing and how do we look in the public eye and can we argue that we do enough small business loans or anything like that. Don't worry about doing that because we've got you covered. Here's a small bank being set up in the area who's going to cover all the small businesses that aren't being covered by you and aren't being.
It's complementary to the bigger banks. Exactly,
and likewise for small banks want a big bank because they want to be able to any business that's too big for them, they want to be able to send it to a big bank and say, go and speak to these guys instead. They'll help you.
Gotcha. Wow. So I know that you guys are probably going into alpha testing Q4 of this year. Is that correct? Yeah.
On the tech side.
Awesome.
Yeah. But and this is what I said, I always said this to the tech guys, Rome, who's our CTO, who's brilliant. I always said this to him right from the start. I said, look, the roadmap on the technology side isn't going to be what we're waiting on. The banks take a long time. The banking license application takes a long time. And that will always be the sort of the something that we have to hurry up and get on with because it takes a long time to go through. Because we can't really hurry up the regulators. Once we submit that application, it's going to take the regulators between 6 and 12 months to approve us. And that's already after we've spoken to them many times and we have a good idea that they're going to approve it. It's going to take about 6 to 12 months. So it's a long process.
So give us,
of course.
give us an ideal scenario of, say 5 years down the line, Valhalla Network has had a long time to get these banking license, create the banks that they want, have the DAO fully rolled out. Are you guys going to stay in Europe, or is it a possibility for banks in the States? What's, in your mind, what's the ideal scenario?
Yeah, so in 5 years, that's not very long.
No.
So in 5 years' time, we'll have a phase one bank completely set up and running and generating all these dividends that are flowing to the DAO. And again, the DAO's using these dividends as staking rewards or as airdrops or to reinvest. It's up to the governance token holders what they want the DAO and the foundation to use the dividends for that the foundation's receiving. But it's likely going to be a lot towards staking rewards. So you've got a phase one bank generating all these dividends. In 5 years' time, we should have at least sort of 2 community banks also set up in the network. I'd say in 10 years' time, though, there's no reason why we haven't got 30 community banks set up. And that's still that phase one for-profit bank, that specialist for-profit bank phase one, still running, still generating all those dividends. And then in 10 years as well, those first few community banks that were started up will have already started generating dividends as well, because they've got to their stage in their life. They're about 4 years old. They're at their stage in their life where they're profitable and they start flowing dividends to the DAO as well. So now the foundation's receiving even more dividends from a phase one bank, but now dividends from these community banks as well. So we've got about 30 community banks, let's say. Now 30 is not a huge number. Now this is why, again, when people say to me about which countries are you setting up in and the sort of concentration and all this, again, it's not my decision. It's the token holders' decision. It's governance token holders making this decision. They might say after 6 years, right, we want to set one up in the States. Now, personally, I don't think that's going to happen. I don't think it's a good idea. Why? Because we want to make sure we've got good footing first in Europe. We want to be in a jurisdiction where there's enough space for us to set up banks, and normally any country there is, because you can set up 1,000. Like Germany has 1,500 community banks. If we had 1,500 community banks in Valhalla Network, we would be way over Bitcoin, like much higher than Bitcoin. We would be probably 10 times the market cap of Bitcoin in the market cap of our coin. And that's one country. So we could just be setting it up in one country for the next 30 years, really. But that's unlikely. The governance token holders won't want that. So they'll want to set up a few here, then a few maybe in Greece and a few in Italy and then maybe a few in and I see it, but I want it to go all over the world. So then a few in the States. Okay, while that's happening, we've grown even more. We've hired more people. So we've got more bankers on the banking side working with us, more consultants to set up more licenses in Italy. While that's happening, there's more working in Greece. While that's happening, there's some working in the States. So we can start building and say, okay, well, if we're now working in the States, we can have a team focused on the States. We can have a team. So then we can actually start setting up banks across in these different countries all at the same time. And we can really start growing quite quickly. But to get to that stage, you really need a good, strong foothold where you've got some money coming into the foundation, so investors are protected and the foundation's protected, and the network's protected, and you don't want to just rush into it, because if you rush into it, you're likely to make mistakes, you're likely to be rejected, and you're going to waste a lot of money, because every single jurisdiction you want to start up in has different rules, different banking regulations. You've got a different regulator that you need to speak to who don't know you. You've got a different bank license application process. So you've got different documents that you've got to fill out. The documents which are the same are likely to be a different way of filling them out. You've got different capital requirements. So, for example, really good example of this is Luxembourg is something like 12 million, and Lithuania is something like 1 million. So, completely different capital requirements for different countries you go to. So you don't want to try and run before you can walk and just spread out everywhere. You want to first get a few set up and a few running and dividends flowing to the foundation. And then once that happens, you can then start saying, okay, now we'll start setting up in different jurisdictions. We'll start hiring more people and we'll start growing. But yeah, certainly. I see it being something that in 10 years will be in at least 2 continents.
That's brilliant. I love the concept. You mentioned also staking rewards. So how would that work if I was a DAO token owner? Would there be a lockup period? So say I stake my tokens and I lock them up for 4 or 5 years. and now I have that dividends coming in, and that DAO token is locked up. Is that how it'll work?
So when you're a governance token holder, not if, when you're a governance token holder, the way it will work likely is just over a year period. But and in fact, I'm traveling up to London tomorrow to see the team to have a intensive sort of work session over the weekend to nail out some of these things that we're still questioning. And it's not just my decision. So I'm not going to say to you, this is exactly how it's going to work, because the team haven't finalized it yet. Tokenomics is such an important part of DAO and of a protocol, and it's overlooked many times. People think that they can get away with just simple tokenomics model, but that might not work. You might have complications down the line. So we are really modeling it out and testing it and stress testing our tokenomics. Rome is really good on that, and he's really keen to make sure our tokenomics is up to standard. So, and isn't going to break down and have any problems. So we haven't exactly decided on exactly the lock-in periods, but the way it will work is there will be some sort of lock-in period, and maybe it's monthly up to a year and the amount's different. There's likely to be some sort of fixed rate, and there's also going to be some sort of tie between how much you're engaged with the DAO itself and how many proposals you're voting on, and what percentage of your staking reward you receive. So to explain this, Jaime, is it Jaime? I can't remember. Jaime? Oh, you're muted. Joey. It's easy. I know how to pronounce Joey.
Jaime or Jamie is fine.
Oh, Jaime or Jamie. Okay, Jaime. So you're a governance token holder. You're staked, let's say, for a year. Now, we say to you at the start of the year, because we've got forecasts for what the banks are going to be doing. So we've got financial forecasts for the upcoming year of how many dividends we believe and let's keep it simple, the phase one bank, just the phase one bank, is going to make by the end of the year. So we've forecasted that out, and we think that the amount of dividends that are going to flow into the foundation will support a staking rate of 15% for your tokens. So I say to you on the screen, your fixed rate is 15% if you lock your tokens in for a year. You lock your tokens in, proposals are coming in. You're voting on half of them, let's say. So maybe you don't want to be actively always contributing, but you do want to still be actively involved in the process of governance process. And we want token holders to be actively involved. So you might vote on half of them, let's say. At the end of the year, you're then entitled, because you voted on half of them, let's say you might be entitled to 80% of your staking reward. And it will all be outlined clearly. So then you knew that if you voted on all of them and if you were actively participating, or if you voted on 70% of them or 75% of them and above, you're entitled to 100% of your staking reward.
Yeah,
it might
incentivizing me to participate in the voting.
Exactly. You get your staking reward at the end of the year, and the way that's going to work is the foundation is receiving those dividends from a bank. So the phase one bank is paying the dividends into the foundation. It was forecasted. It's about the same dividends as was forecasted. The foundation is then saying, great, you've got your staking reward. Here's 15% more tokens. You've been given 15% tokens. We are now going to use that staking reward, the dividends that are coming in. Governance token holders, how would you like us to use it? And governance token holders are very likely to say, we'd like you to use it to purchase tokens back from the market to stop there being an inflation of token count. So therefore, okay, so then you might put your tokens on the market and the foundation will buy them off you. Something similar, something like that. Now let's say, okay, but that dividend was a forecast. Now let's say that something happened and the bank is only able to get us half the dividends we expected. But we can still support a 15% staking reward. Why? Because the staking reward is in tokens, so we can still give you those 15% tokens. It just might be that we can only buy, half of the tokens that we issued back from the market. And that means governance token holders then have to vote on what they want to do in the future year. Do they want to reduce the staking reward? Do they want to make sure that we can purchase back more tokens? Or are they happy with there being a higher circulation? So it's very, you can't predict the future. We know we can't. We're being very honest about that. We're forecasting the future, but we can't just say this is definitely going to happen. So we can forecast it and based our percentages and everything off that. And then governance token holders have to react and have to run it and govern it. However, there's the alternative, which is a flexible rate, which is what we can do as well, where we can say, okay, well, if you're the first person coming in, you're going to get a higher, you at the moment, it's looking like a higher rate. And the more people who are staking their tokens, the rate comes down because we can't support all those people getting that rate. So the rate has to drop. That's how a lot of protocols are working at the moment. It's a really attractive high rate. So yeah, let's chuck loads of money into that. And now suddenly we're not getting that high rate anymore because there's so much money going into it. So now we move our tokens out and we want to put them in something else which has a high rate to start with. It's just, I don't really like that. I think it's sort of a little bit disingenuous because you're sort of promoting and advertising this really attractive and high rate when maybe after 2 days a rate has already come down, way down to where it started. So I just think it's a bit, I don't like it. I don't think it's honest. Whereas I think a fixed rate where you're being very clear to people what they're receiving is much more in line with sort of the banking sort of regulation, how everything is so regulated that you need to be very clear. And I think that's just much more clear and transparent to governance token holders.
Yeah, a model that I've seen used in a lot of other tokens that I thought was pretty cool is the interest varies on the time you're willing to lock up. So if you're willing to do, say, a year, 15%. If you're willing to lock up for 5 years, okay, well, now you have, 25, 30%. So it incentivizes people to hold on to that token for longer, and you can't reverse. After it's locked up for 5 years, it's a one and done deal, and it's locked up no matter what. And then it'll also provide, getting some of those tokens off of the free market, and you don't have that inflation issue.
Well, we wouldn't have the inflation issue anyway, but to get rid of the inflation issue by locking tokens up, you're just kicking the can down the road. The only way to permanently get rid of the inflation issue is to buy them back and to lock them or burn them in the foundation. To just lock them up is just kicking the can down the road, because when they're released at some point, then you're going to even need to lock them up again, and then it's like a pyramid scheme to get rid of the inflation.
But kind of like bonds, right?
You're right. The different rate for different locking. Kind of like the whole blinking pension system, but yeah, we will likely have something as well where if you are going to have different lock-in periods, you have a different rate. But again, it's not up to me, and we haven't got the answers right now for me to promise you anything like that.
Awesome, Oliver. So one more question before we end the podcast here. I want to really talk about CBDCs. What you think the effect of CBDCs is going to be in the future of world economies. I know Werner said that there is some pretty positive news that retail CBDCs, at least for the moment, looks like it's not going to be pushed or rolled out. It's going to be more of a wholesale CBDC. So I'm assuming it's going to be more central bank to central bank, settling cross-border payments, something like that. What are your thoughts?
Yeah, so CBDCs have been a threat for many years, and Richard, I think in 2019, he was, or maybe earlier, he was one of the first speaking out about CBDCs and warning people that they were being looked at and they were coming. And Zero Hedge recently did an article on CBDCs, and it was about Richard's video, and at the bottom it said, here's the link for the video. So even them are now promoting him and his sort of view and his work. They are a risk to the banking system, because if you create a CBDCs, retail CBDCs, which are effectively retail accounts at the central bank, what that is doing is that is the umpire or the referee blowing a whistle and saying, right, I'm going to now start competing with the players. And if you do anything, and if you try and take the ball off me or something, I'm just going to blow the whistle and give you a yellow card. Yeah, well, and you've got to get out the goal and just let me kick it in. Oh, that missed the goal? No, I thought it went in, so I'm going to give myself a goal. The ref can do what they want in that point. So that's
a great way to put
retail
it.
CBDC. It makes it very difficult. Yeah, it makes it very difficult for those competing banks and those competing players to ever succeed, because you've got the ref making all the rules and wanting to compete with them. So it's not a good idea ever for the regulator, the one making the rules, to compete. It's never going to be a good idea. So retail CBDCs are not something which people should be celebrating or excited about. It is a concern. However, like you said, and Richard highlighted that recently at the WEF, I think it was, it looked like wholesale CBDCs were more being pushed and retail CBDCs weren't, which is great news. Because although it's still not ideal, it's damn sight better than what it was. And yes, it does start, people might say, well, that opens the door then for retail CBDCs. Okay, but it's better than what it was. It's better than retail CBDCs right now. So yeah, I don't think they're ever going to. I don't think they'll bring in retail CBDCs and destroy the banking system. And people look at that as like a risk to Valhalla Network. And I always say, well, look, not only is this multi-jurisdiction that we're going to be working in, so they'd have to do it in all the jurisdictions we're working in, but also at the point, if anything happened where Valhalla Network was in trouble because of CBDC or something, at that point, every business in your local area started collapsing. Your whole portfolio has gone to zero and everyone is depressed. So, it's a big view to think that the banking system or something like that might collapse, because if it ever did, there's more concerns that you have other than the banking system. You've got concerns of your own family, health and well-being and businesses in your area. So it's quite a dark thing to be looking at. And luckily, it looks like we're not heading that way. And just before we finish up as well, I wanted to briefly discuss interest rate because this is something that people have been, obviously the Bank of England raised their rates this week and the Fed raised their rates and the ECB raising their rates. And people think that it's a bad thing, that rates are going up. They think, one, it's a bad thing on the markets, but two, it's to control inflation. So to start with, and I've had so many arguments with people about this, and the arguments are always the same. They just don't know. And they want to argue it because they're being told it. And they try to use logic. They don't use data. They don't use empirical data. And it's quite frustrating. Interest rates do not control inflation. They do not control GDP growth either. You can set the interest rate high and you can still have inflation. You can set it low and have inflation. It's the credit creation. It's not the price. It's the quantity of credit that's being created and the purpose it's being used for is what decides on inflation, not the price. I can create loads of money, but if it's for real economy, i.e. small businesses, and I'm helping small businesses, it's being repaid. It's being used by those small businesses to grow, and then they're repaying it. So therefore, credit is then being destroyed. So therefore, you've got no inflation, but you've got GDP growth, which is why the real economy is so important. So if you're lending using community banks to these small businesses, you get GDP growth without inflation. It's fantastic. So you can solve the inflation problem. It's like people say, oh, how can we solve it? Really easy. Increase the credit that's being created for small businesses and reduce the credit that's being created for financial speculation and the non-real economy. And the other thing about the interest rates going up is actually going up a little bit isn't a bad thing because it means a healthier banking system. Banks are healthier and more profitable if interest rates are higher. Why is that? It's because their margin increases. Empirical data shows that as the interest rate goes up, the bank's margin increases, therefore banks are making more money. So therefore it's a healthier banking system. If interest rates are going really, really low, banks are struggling. They're struggling to turn a profit over. And community banks are struggling as well. So it's good for the interest rate to be going up a little bit, but it's not going to control inflation. And it's certainly not going to lead to the end of the stock market or people think it does just because they tie the inflation into the interest rate and they tie what the central bank's doing into the interest rate. But actually, the interest rate doesn't mean the central bank is going to do that. It could be a completely different opposite thing.
Yeah, that's something that I struggled with in the beginning when I heard Werner talk about interest rates. I could have sworn interest rates down are good, interest rates up, oh, that's not good. They're controlling inflation. It's going to bring the economy down. And it really took me a long time to really get a grasp of that. And also the whole money creation theories. It's funny, after I watched some of Richard Werner's interviews, I went to work and I went to some of my friends and I asked them, each one of them, like, hey, where do you think money comes from? Who creates the money? And not a single person told me it was banks. Everybody said, oh, it's the government, it's the central banks, it's the Fed. They all create the money. And when I told them, no, it's banks. Any bank can create create credit. They couldn't believe me. A lot of them, I got into arguments with a lot of them. They didn't want to believe me. And it's why do you think it is that the populace doesn't know this or doesn't understand this? It hasn't purposely been hidden away from the mass public?
Two things. So there's not that much transparency in banking and in central bank activities or anything like that. There's really not that much transparency. And the second thing is people are lied to. So people are taught the wrong thing. So when I joined HSBC, in my first week joining there, I had someone come in and who was actually a former investment banker, and I had a little bit of an argument with him about his ethical views when he was talking about, shutting down businesses and taking their collateral. And I spoke about his ethical views and argued with him. But also, his first slide in a presentation he was giving to me and about 30 others in a room was, what are banks? And banks are financial intermediaries. And I immediately put up my hand and said, how can this be true when banks create money? And that's been not only proven by Werner, but it's been accepted and explained by the central bank, by the Bank of England. This guy had no idea what I was talking about. He was trying to teach neoclassical economics and trying to teach that banks are financial intermediaries. And that is incorrect. So all these bankers who are sitting there are being taught this. They're just, oh, yeah, banks are financial intermediaries. Yeah, we're just sucking it in. We're just, lapping it up. Yeah, fantastic. So now we go away and think banks are financial intermediaries. Yes, they're not important at all. So it's because people are being taught the wrong thing as well. So that's a big one. But yeah, one another big thing we want to do with the community banks and talking about the problems with centralization is you saw what happened with Canada recently when there was donations happening and stuff like that, and how they just froze people's bank accounts that were related to donations or anything like that. It's much easier to freeze few bank accounts and tell a few banks to freeze accounts than it is to tell thousands of banks and to control 1,000 banks and make sure they all freeze accounts on those people. The more decentralized it is, the harder it is to control for potentially malicious reasons, which is a good thing. And then if you can have every single community bank as well offering an off-ramp, a crypto on and off-ramp. So at the moment, same problem with crypto exchanges and ramps is that they're very centralized. Whereas if we can say that every single community bank that we offer will also, within regulations, will offer an on and off ramp, you're suddenly decentralizing the on and off ramp process. So, you're taking away that centralization problem as well from crypto exchanges and accessing the crypto.
So would you do that with a DEX, a decentralized exchange?
No, what we're thinking is that the banks themselves, obviously, we'll have to make sure we're within all the regulations and we'll work with a regulator on it. And this isn't like part of the core plan. This is just a vision that we have that hopefully one day will happen. That the community banks we set up will be able to offer on and off ramps for their customers so that the customers in their area can also access cryptocurrencies and purchase Bitcoin or whatever through their bank, through their banking.
Oliver, I have to say that was honestly brilliantly stated. That was a very well put. I really appreciate that. When it comes back to, I want to touch really quick on kind of, your investment banker example. It's so funny because I know Richard has always talked about how everyone's being taught, or most economic theory is saying how inflation basically, or not inflation, but the rates, the whole positive correlation, or is it a negative correlation? It's the negative correlation, when in fact it's really a positive correlation, and there has been no actual empirical testing this. I guess Werner did the first one. I thought that was so interesting, so brilliant, and it's just crazy how there's really a lack of financial or economic literacy going on, and then we have people coming in running the show. Meanwhile, retail is really paying the price and small banks are paying the price. So I just thought that was, you literally brought in a real life example. I thought that was awesome.
It's positive and in the other direction. So what people are taught is that as interest rates go down, the economy goes up, GDP goes up. And it's actually, the data shows that it's in the opposite direction and the relationship goes the other way. So it's looking more like as the economy goes down, interest rates follow and go down. As GDP grows and economies do well, interest rates tend to follow it and just go up behind it and it lags it. But yeah, and it's the same with his empirical test on banking. You had for over a century and a half, bankers and economists would argue about what banks are and how important they are. You've got financial intermediation theory. you've got the fractional reserve theory, and you've got the credit creation theory. And it wasn't until 2014, I think it was, Professor Richard Werner did the first ever empirical test in the 2,000-year history of banking to actually prove what banks are. Are they financial intermediaries? Are they creators of credit? And it's crazy. So you're right. There's a lot of people arguing it, but actually very few people looking at the data and building a model based on the data.
Yeah, I thought that my mind was absolutely blown, and it's just crazy because you would think, everything is structured off these theories, and really no one has done the test yet to actually run it. So that was definitely eye-opening, to say the least.
Mm.
And I feel it's important for more people to understand these theories. I feel if the public understood this is how we get healthy economies, and interest rates when they're up, it's actually good for the economy. And if banks are lending for productive business credit, well, that's where we get good economic strength and economic growth, not just for asset appreciation or for consumption, like Werner says. I think a lot of people would change their aspects or their mindset on how economics works and how banks work, and things kind of like Valhalla Network would flourish with small banks.
So,
yeah, and we're seeing a lot of support for it as well. We've had a lot of the investors. We've had great early stage investors who are supporting the project to see a better banking system come through. And, the investors are actively trying to get involved as well, giving us suggestions, working with me, talking to me, giving me advice. They're fantastic guys that are supporting the project. We've done very little marketing really, and already we've raised just under 8 million euros in our private raise. So it's going really well. And with a little bit of marketing, we think we can easily close out the private raise before the summer next year. So yeah, really exciting.
If someone wanted to get involved, where would they go to go ahead and invest and learn more about Valhalla Capital or Valhalla Network?
Yeah. So they can go to our site, which is valhallanetwork.io, or they can just look at my profile or Richard's profile on Twitter, but mine has the Valhalla Network link. So on Twitter, it's Valhalla DAO _, and in the website links on there as well. Then go on there, it outlines what we're doing. It has the white paper available on there as well. And then there's a contact us portal, a link for them to get involved or reach out if they're interested in investing. Or they can reach out to me directly, Oliver at valhallanetwork.io. Our minimum investment at this stage is 30,000 euros because of the amount we're raising. Anything so small, and it's admin for me. Every single investor, I want to make sure that they understand what they're investing in, and then I need to do all the administrative tasks. So we have to set some sort of minimum. So the minimum is 30,000 euros. And then when we do the public sale next year, end of next year probably, that'll be no minimum, and that's 55 million raise. So that's a much larger raise with no minimum.
Beautiful. Yeah, we'll put that all in the description. Access to the website and to the white paper and all of your Twitter information. Thank you so much, Oliver, for being on the podcast. I really appreciate it, and I really hope that we can meet again in the future, kind of touch back on what you've been doing and the state of the world economy sometime in the future.
Yeah, awesome. Thank you for having me,
guys. Thank you, Oliver. It was a pleasure.
Really
Absolutely, man. Thank you so much.
Take care.
All right,
Cheers.
Bye-bye.
Bye.
Thank you.